We continue in Chapter 2. Now that we've learned how to journalize business transactions, we're going to post these journal entries to the ledger. So our learning objectives here: number 1, post the journal entries to the ledger. Number 2, prepare a trial balance to test the equality of the debits and credits that we posted. Okay, now a ledger is a complete collection of all accounts of a company into different groups here. Now there are balance sheet accounts, asset, liabilities, and shareholders' equity. And within the shareholders' equity, we have the income statement accounts, revenue, and expenses. Balance sheet accounts are permanent records because we don't close them out or transfer their balance at the end of the accounting period. But the income statement accounts, as well as dividends, are referred to as temporary accounts because they contain revenue and expense and dividend information only for that accounting period, and they are transferred to the retained earnings at the end of the period. So here's a visual picture of the different accounts in the ledger. You have equipment, land, supply. Every asset has its own account. Same with liabilities. And in the equity section we have revenue and we have different expense accounts. Now, in order to keep track of all of this, every business has what's called a chart of accounts. It's like a table of contents, and that's the order in which the accounts are in the ledger. For example, each account is given a number. Asset accounts are given numbers between 100 and 199. Liability accounts are 200s. Stockholder and equity accounts are 300, revenue 400, and expense 500. So here's a picture then of the different chart of accounts: asset, liability, and revenue and expenses. So now we take the journal entry that we recorded in the general journal. We said debit cash 10,000. Well, we go to the general ledger, we pull out the account called cash, and it has an account number 101. And in here we record the date of that transaction and the debit. Just as the journal entry said, debit cash 10,000, we're doing that. And we keep an ongoing balance in the outside column, in this case 10,000. And in order to cross-reference the ledger to the journal, we take the number on the ledger and we record it in the journal. So at any time I can go back to the general journal and read what was the transaction that increased cash by 10,000. We do this now for every journal entry. If I was to continue this example, then I would go to the common stock. Common stock account would be in the 300s. I'd pull that out and record a credit in the common stock and reference back the same reference 101 because it's on, or the same reference would be the number of that account. After posting everything, we take what's called a trial balance, and that is simply a listing of the accounts and their balances at any point in time, in this case October 31st, 2012. And the purpose here is to make sure that the debit balance accounts equal the credit balance accounts. We simply list them. Debit cash, they had a balance 15, to supplies 25, and so on. There is our common stock 10,000. So you see that we have equal debits and equal credits. This is just a check to make sure that we've journalized properly and we've posted properly. From this point we can then begin to prepare to produce financial statements of a company. But there you have the posting to the general ledger.